This week isn't just another week in silver markets. Three major catalysts are converging in the next 5 trading days that could completely transform the trajectory of silver prices for the rest of 2025. Federal Reserve decision Wednesday. Critical COMEX delivery deadline Friday. China's export restriction enforcement deadline Saturday. These 3 events happening within 72 hours of each other has never occurred before, and each one individually has the power to move silver 5 to 10%. Combined, we could see a move that redefines what investors think is possible in precious metals. This is the week that separates those who positioned early from those who chase late. This is the transformation point. Let me break down exactly why this week is so critical, starting with the Federal Reserve meeting on Wednesday. The market is pricing in a 73% probability of no rate change. But here's what matters more than the decision itself. It's what Powell says about future rate cuts and inflation trajectory. If Powell signals that rate cuts are coming sooner than expected, or if he acknowledges that inflation is proving stickier than the Fed anticipated, it changes the entire narrative for precious metals. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. Persistent inflation increases demand for real assets as inflation hedges. Either scenario is bullish for silver, and the market hasn't priced this in yet because everyone expects a hawkish hold. If Powell surprises with dovish language about potential cuts in Q2 or Q3, silver could gap up 3 to 5% immediately on the statement. But there's another dimension to the Fed meeting that most people miss: the dot plot projections. If the median dot plot shows more rate cuts expected for 2025 than the previous projection, it signals the Fed's own economists see economic weakness ahead that will require accommodation. Real interest rates are what drive precious metals more than nominal rates. If the Fed projects more cuts while inflation expectations remain elevated, real rates go deeper negative. And negative real rates are rocket fuel for silver. The last time the Fed shifted from hawkish to dovish during a period of elevated inflation was 2019. Silver rallied 47% over the following 18 months. We could be at a similar inflection point this week. Now let me show you the second catalyst. Friday is first notice day for March COMEX silver futures delivery. This is when contract holders declare whether they want physical delivery or will roll to the next month. And the setup this month is extremely unusual. Open interest going into March delivery is 184,000 contracts. That represents 920 million ounces of silver. But registered inventory available for delivery is only 42.1 million ounces. The ratio is 21.8 to 1. For every ounce of physical silver available, there are nearly 22 paper claims. If even 2% of open interest stands for delivery, that's 3,680 contracts, or 18.4 million ounces. That would consume 44% of the entire registered inventory. And we're already seeing signs that delivery demand is running hot. Pre-positioning data shows that deliverable positions, which are contracts held by parties eligible to make or take delivery, are up 38% compared to the February delivery month. That suggests significantly higher delivery demand is coming. When delivery demand exceeds available registered inventory, one of 2 things happens. Either price has to rise to incentivize holders to deliver metal into the system, or the COMEX has to transfer metal from eligible to registered inventory, which depletes the broader warehouse stocks. Either scenario is bullish: higher prices to attract supply, or lower total inventory that tightens the market further for future delivery months. This Friday's delivery data will tell us which path we're on. The third catalyst is China's silver export restriction enforcement deadline, which technically hits Saturday but will impact markets Friday. China implemented permit requirements for silver exports effective March 1st. We're now in the first full month of enforcement. Early data suggests permit approvals are running 55–65% below typical export volumes. That means China is holding back 35–45% of its normal silver exports. China exports roughly 3,800 tons annually. A 40% reduction is 1,520 tons, or about 48.9 million ounces. Removing nearly 50 million ounces from global supply in a market already running a 118 million ounce annual deficit is transformative. It widens the deficit to 167 million ounces. At that deficit rate, above-ground inventories reach critical shortage levels within 8 to 10 months. But here's what makes this week critical. The first month of data showing actual export volumes under the new restrictions gets reported this Friday. If the data confirms that China is indeed holding back 40–50% of exports, it will force market participants to reprice silver based on the new supply reality. Industrial users who thought Chinese supply would still be available will panic buy to secure alternative sources. Investment demand will increase as the shortage narrative gains mainstream attention. And the COMEX, which relies on global supply flows to maintain inventory, will face additional stress. Now here's where these three catalysts become transformative when they converge. Wednesday's Fed decision could weaken the dollar and lower real rates, creating macro tailwinds for silver. Friday's delivery data could expose physical market stress and force recognition of the supply shortage. Friday's China export data could confirm that 50 million ounces of annual supply is gone from the market. Each catalyst individually is significant, but all three hitting within 72 hours creates a perfect storm that could completely transform market psychology around silver. Investors who view silver as a boring, range-bound metal could suddenly see it as a supply-constrained commodity in the early stages of a shortage squeeze. The transformation isn't just about price moving 5% or 10% this week. It's about the narrative changing from silver is consolidating to silver is entering a supply crisis. That narrative shift is what drives sustained bull markets that last months or years. And it all happens this week. Let me show you the specific price levels and market reactions to watch this week, because understanding what confirms the transformation versus what's just noise is critical for positioning correctly. This isn't about reacting to every tick. It's about identifying the signals that tell you the transformation is real. For the Fed meeting Wednesday, the key level to watch is silver's reaction to $33.85. That's been resistance for 3 weeks. If Powell's statement is dovish and silver breaks above $33.85 with volume, that confirms the first leg of the transformation. Target would be $35.20, which is the next major resistance. But more important than the immediate price reaction is the dollar response. Watch the dollar index. If it breaks below 106.20 on the Fed statement, that's confirmation of dovish interpretation. And with silver's 0.82 correlation to the dollar, that breakdown should pull silver significantly higher. The 10-year Treasury yield is equally important. If yields drop below 4.18% on the Fed news, it signals that the bond market believes rate cuts are coming sooner than previously expected. Falling yields reduce the opportunity cost of holding silver and typically correlate with precious metals rallies. So the confirmation signals for Wednesday are silver above $33.85, dollar below 106.20, and yields below 4.18%. If you get all three, the transformation from the Fed catalyst is confirmed, and you should expect follow-through over the following days. For Friday's delivery data, the key number to watch is first notice day delivery intentions. Historical average for March is around 1,800 to 2,200 contracts standing for delivery. If we see 2,800 to 3,500 contracts, that's significantly elevated and confirms stress in the physical market. But the real transformation signal is the registered inventory response. If registered inventory drops below 40 million ounces during March delivery month, it crosses a critical psychological threshold. Below 40 million ounces, the ratio of open interest to registered inventory exceeds 23:1. At ratios above 23:1, the COMEX has historically struggled to maintain confidence in its ability to deliver. We saw this in 2021 when the ratio hit 25:1, and silver spiked from $25 to $30 in days as concerns about COMEX integrity spread. Watch for any announcements about delivery delays or force majeure declarations. If any major player declares inability to deliver on scheduled timelines, it would be the smoking gun that transforms market perception from tight but manageable to crisis. The other signal to watch Friday is the eligible to registered transfer rate. If the COMEX has to transfer 5.7 million ounces from eligible to registered to satisfy March deliveries, it depletes total warehouse stocks and sets up even worse conditions for April and May delivery months. For the China export data Friday, the transformation signal is confirmation that exports are down 35% or more year over year. Anything less than 35% reduction can be explained as normal volatility, but 35–50% reduction confirms the restrictions are being strictly enforced. Watch for responses from industrial users. If major solar manufacturers or EV producers issue statements about silver sourcing challenges or announce supply agreements with non-Chinese producers at premium prices, it confirms that the China supply loss is real and impactful. The base metals complex gives you early warning. Copper, zinc, and lead all come from similar mining operations as silver. If those metals rally on supply concerns Friday, it suggests the market is recognizing that China's export restrictions extend beyond just silver to the entire polymetallic mining complex. Now let me show you the positioning strategy for this transformative week, because how you position matters as much as whether you position. This isn't a week to be passive. This is a week to be tactical and prepared to act on confirmation signals. Monday and Tuesday, before the Fed meeting, use any weakness to add to core positions. If silver dips to $32.80 or lower, that's a gift. You're buying before the catalyst with a tight stop below $32.50. Risk is minimal. Reward is substantial if Wednesday delivers dovish surprise. Wednesday after the Fed statement, watch for the confirmation signals. If you get silver above $33.85, dollar below $106.20, and yields below 4.18%, add to positions aggressively. This is momentum confirmation that the transformation is starting. Don't wait for pullbacks. Chase the momentum. Thursday is typically a digestion day after Fed meetings. Price might consolidate or pull back slightly. Use any Thursday weakness to position for Friday's delivery and export data. The market will be focused on those numbers, and any weakness Thursday is just traders taking profits from Wednesday's move. Friday morning before delivery data releases, tighten stops to break even or small profits. You don't want to give back gains if the data disappoints. But keep position size intact, because if the data confirms stress, the afternoon rally could be explosive. Friday afternoon, if delivery data shows 2,800 plus contracts standing and China data confirms 35% plus export reduction, add final tranche to positions. This is confirmation that both physical catalysts are playing out. The transformation is no longer theoretical, it's factual. The position sizing for this week should reflect the unique convergence of catalysts. This isn't a normal week where 5% allocation makes sense. This is a potential transformation week where 8 to 12% allocation is justified for aggressive traders who understand the setup. But that allocation must come with strict risk management. Stops below $32.50 are non-negotiable. If silver breaks that level, it invalidates the entire transformation thesis and you exit immediately regardless of catalysts. Now let me show you what makes this week's transformation potential different from normal catalyst events, because understanding the structural differences helps you gauge the sustainability of any move that develops. This isn't just about a one-week spike that reverses. This is about a potential regime change. The difference is that all three catalysts this week address structural issues, not cyclical ones. The Fed's policy direction determines the real interest rate environment for months ahead. COMEX delivery stress reflects years of inventory depletion. China's export restrictions are policy decisions that won't reverse quickly. When structural catalysts converge, they create lasting changes in market dynamics. Compare this to cyclical catalysts like a single economic data print or a temporary supply disruption. Those create price spikes that fade when the immediate catalyst passes. Structural catalysts create new equilibriums, new price ranges, new market behaviors. This is why this week has transformation potential rather than just volatility potential. Let me show you the historical precedent for multi-catalyst convergence weeks in silver. We've only had 3 instances in the past 15 years where 3 major catalysts hit within the same week. March 2020 was one. The Fed went to 0 rates. COMEX had delivery issues during COVID, and China shut down production. Silver bottomed at $11.62 that week and rallied to $30 over the following 5 months, a 158% gain. The transformation that week was complete. Silver went from being a forgotten industrial metal to a must-own monetary hedge. September 2010 was another. The Fed announced QE2. COMEX inventory dropped below key levels, and China increased strategic reserve buying. Silver rallied from $19 to $50 over the following 7 months, a 163% gain. The third instance was November 2008 during the financial crisis. The Fed slashed rates, COMEX had settlement failures, and China announced stimulus. Silver bottomed at $8.88 and rallied to $21 by December 2009, a 136% gain. The pattern is clear. When 3 structural catalysts converge in a single week, the transformation isn't just a temporary price spike. It's the beginning of a sustained bull market that lasts 5 to 12 months minimum. Now let me show you why the current setup might produce an even larger transformation than those historical examples. The supply deficit is worse now than any of those prior instances. In 2008, the market was roughly balanced. In 2010, there was a small deficit. In 2020, the deficit was beginning to form. Today, we're running a 118 million ounce annual deficit that's about to widen to 167 million ounces with China's export restrictions. That's unprecedented. We've never entered a multi-catalyst convergence week with a structural supply deficit this large. The COMEX inventory is also more stressed. In all 3 prior convergence events, registered inventory was above 60 million ounces. Today, it's at 42.1 million ounces. The ratio of open interest to inventory is higher than it's ever been at these convergence points. Industrial demand is stronger. In 2008, industrial demand was falling due to recession. In 2010, it was recovering but still below peak. In 2020, it was disrupted by COVID. Today, industrial demand is at all-time highs and accelerating due to solar, EVs, and 5G. So we have worse supply deficit, lower inventory, higher industrial demand, and 3 major catalysts hitting simultaneously. The ingredients for transformation are more powerful than any prior convergence event. Let me show you the investor positioning difference because this amplifies the transformation potential. In all 3 prior convergence weeks, silver was either unloved or actively being sold. Sentiment was bearish or neutral at best. In March 2020, everyone was panic selling everything. In September 2010, the consensus was that QE wouldn't work and deflation would dominate. In November 2008, the world thought the financial system was ending. Today is different. Sentiment isn't bearish, but it's not euphoric either. The daily sentiment index for silver is at 51%. That's neutral. And here's why that matters. When transformation happens from bearish sentiment, you get a relief rally. When it happens from neutral sentiment, you get FOMO. FOMO-driven rallies are more powerful than relief rallies because they pull in new money rather than just covering shorts. There's a massive pool of investors who are neutral on silver right now. Not bearish, just neutral, waiting, watching. When this week's catalysts confirm the transformation, that neutral crowd becomes buyers all at once. They're not covering shorts. They're initiating new longs. That's pure buying pressure, with no offset from short covering exhaustion. The options market structure also amplifies transformation potential. There are 89,000 call contracts open from $34 to $40 strikes. If silver breaks above $34 this week and heads toward $35, those calls start going in the money. Market makers who sold those calls have to buy futures to hedge their delta exposure. This creates a gamma squeeze where dealer hedging adds buying pressure that pushes price higher, which brings more calls in the money, which requires more hedging. It's a feedback loop that accelerates the move. We didn't have this option structure in prior convergence weeks. Options open interest was much smaller. The gamma squeeze dynamic wasn't as powerful. Today, it's a rocket booster that could take a 5% catalyst-driven move and turn it into a 15% momentum-driven surge. The transformation this week isn't just about these three catalysts. It's about these catalysts hitting when the market is more structurally vulnerable, more supply-constrained, and more positioned for upside acceleration than ever before. Let me show you exactly what a transformed silver market looks like after this week plays out, because understanding the destination helps you hold through volatility and avoid taking profits too early. Transformation isn't just higher prices. It's a complete change in how the market behaves. The first characteristic of a transformed silver market is sustained higher volatility. Right now, average daily range is 0.35. In a transformed market post-catalyst week, average daily range expands to 0.80 to $1.20. Price moves that currently take a week happen in a day. Higher volatility sounds scary, but for positioned investors, it's how you compound gains quickly. A $1 daily range on a $35 silver price is 2.9% daily volatility. String together a few positive days and you're up 10-15% in a week. The second characteristic is persistent premium expansion in physical markets. Right now, premiums are elevated at 6 plows on Eagles. In a transformed market, premiums go to $8 to $12 as the shortage becomes undeniable and retail panic buying intensifies. When premiums expand that dramatically, it creates a one-way physical market. Nobody sells back to dealers because the bid-ask spread is too wide. Every ounce of retail buying is effectively permanent removal from circulation. This amplifies the supply squeeze. The third characteristic is media coverage shift. Right now, silver gets mentioned occasionally in financial media. In a transformed market, silver becomes a daily headline. CNBC has dedicated silver segments. Bloomberg runs supply shortage stories. Mainstream investors who never thought about silver suddenly want exposure. This media amplification brings new money. The silver market is small. Total above-ground investment inventory is roughly $60 billion. If media coverage drives just 1% of global investment portfolios to allocate 0.5% to silver, that's over $5 billion of new demand hitting a $60 billion market. The math doesn't work at current prices. Price has to rise significantly to ration that demand and bring the market back to equilibrium. The fourth characteristic is technical breakout confirmation. In a transformed market, silver breaks through resistance levels that held for months and doesn't look back. The $34 level that's been resistance becomes support. $36 becomes the new floor. The entire trading range shifts higher. This technical transformation attracts algorithmic traders and momentum funds who weren't involved before. They see the breakout. They see the new trend. They allocate capital mechanically based on signals. This adds another wave of buying that sustains the rally. The fifth characteristic is correlation changes. Right now, silver trades with a 0.82 correlation to the dollar. In a transformed market, silver can rally even if the dollar doesn't fall. It becomes uncorrelated or develops positive correlation to risk assets as investors view it as both inflation hedge and industrial growth play. When correlations break, it tells you the market is being driven by its own supply-demand dynamics rather than just macro factors. This is a hallmark of commodity markets entering genuine shortage. They decouple from normal relationships and trade on their own fundamentals. Now let me show you the time frame for how this transformation unfolds, because it's not instantaneous. The catalysts this week plant the seeds. The transformation grows over the following 8 to 12 weeks. Week 1, which is this week, you get the catalyst events. Price might spike 5 to 8% if all 3 catalysts deliver. But more importantly, you get the initial narrative shift. Market participants start discussing supply shortage seriously instead of dismissively. Weeks 2 through 4, you get the follow-through rally. This is when the initial catalyst-driven spike is validated by continued buying. Price grinds higher steadily. Each dip gets bought. Resistance levels that held for months break easily. This phase typically adds another 10–15% to prices. Weeks 5 through 8, you get the acceleration phase. This is when media coverage intensifies, when retail FOMO kicks in, when the move becomes obvious to everyone. This is where the explosive gains happen. Silver can add 20–30% in this phase as momentum feeds on itself. Weeks 9 through 12, you get the climax phase. This is euphoria. Everyone believes silver can only go up. Valuations don't matter. Every pullback is bought immediately.
This is when the smart money that bought during Catalyst Week starts taking profits. The total transformation from Catalyst Week to peak typically takes 10–14 weeks based on historical patterns. From $33 to $48 would be a 45% gain over that time frame. Not impossible, not unprecedented, just requires the catalysts to deliver and the supply shortage to play out as expected. But here's the critical point. You can't time the peak. You can't know when week 12 becomes week 13 and the reversal starts. So the strategy is to take profits in stages. Sell 25% at $38, sell 25% at $42s, sell 25% at $46. Let the final 25% run for the potential 50+ of moonshot. This ensures you capture the transformation gains without trying to perfectly time the top. You lock in profits as the market transforms. You don't give it all back when the inevitable correction comes. The transformation starts this week. The catalysts are aligning. The Fed, COMEX delivery, and China export data all hit within 72 hours. Each one has the power to shift market dynamics. Together, they have the power to completely transform silver from a forgotten metal into the hottest commodity trade of 2025. The question isn't whether transformation is possible. The question is whether you'll be positioned before it becomes obvious to everyone else.